Hello everyone, welcome to this video where I'm going to go over projects 1 and 2. I know there's been a lot of confusion or I guess frustration about how to do these projects. My fault, maybe I'm thinking the projects might be overly ambitious, so in the future I may change them up a little bit. But with that being said, some of you did absolutely perfect, and I'd say, let's see, about 20% of the class got everything exactly right with the projects. But that means a group of you I could see were struggling, and I've been meeting with some students both offline and on campus about the project. So I thought, let me shoot a video for those of you who may not be saying anything, just kind of walk through these projects, project 1 and 2. So this is going to be a long video. Feel free to go back into different parts of the video as I go in and out through projects 1 and 2, and I'll show you how I solved them. Now, these projects are not from, I guess from a textbook or a provider. They're ones that were made up. So, there could be an error in there. So I guess I'll put my little caveat out there that I may have messed up with the construction of the projects, but so far I think it's relatively okay. There was a small little transposition error with project 2, but really didn't affect project 2 in its completion, and you'll see that as we get to that. I'm also going to be using PDFs and going back and forth between the journal entries and the T accounts, which is the way I like to do things. I'm going to show you how I approach it because, like everyone, the accounting skills get rusty, so I always go back to fundamentals. And when I do my journal entries, and I always like going back to using T accounts. So I'll show you how I did that to solve these two projects. All right, so let's jump into the projects, and I'm going to go through each one by one. Again, if you are okay with skipping forward, please do that. I have provided below this video links just to the solutions. So you may look and say, hey, I got everything right except one particular question. You could feel free to fast forward to that particular question. And of course, call me out if I have recorded any of these transactions incorrectly. So far, I think I'm okay. So, but you never know. You never know. All right, so let's jump in and take a look at projects 1 and 2. All right, so first of all, when you take a look at it, I guess try not to think too much about the transaction and take it at its face value. So on number 1, or letter A, on November 1st, whoops, sorry about that. November 1st, stockholders invest $50,000 into a business. Well, the answer is your cash account, you're going to have a debit to the cash account and a credit to contributed capital. Now, and remember that when you look at these journal entries, you are always going to have, hard for me to do that, but you're going to have hard for me to write here, but you're always going to have your debits here and your credits here. So you've got that. One thing I just noticed that I should have been following proper form and I didn't. The credit area, this should be indented, so bad on me. But no one's getting points off for that. But just know that with the journal entries, there's an indent on the credit side. So, and you'll hear me saying this throughout. I'm always constantly mumbling to myself, debits, credits, which one goes on which side and which one does what. Because you have to reinforce that. That's the only, I guess the only magic to this is repetitive, and this course isn't designed to make you accountants. And I'll just say this too, that these projects aren't designed to make you perfect bookkeepers or accountants. All I want was for you to get a familiarity with it, give it a good try, and all of you did. Give it a good try. As managers, you'll never do this. You'll never do this at all. What you will deal with, the ledger accounts. On a very basic level, like in my case, it's what account am I using for a particular whatever, I'm buying something for the college, what account am I going to have it allocated to? And then our our bookkeeping people, they take care of all the rest. So again, that's a bookkeeping and accounting process. But you want to know what happens behind the scenes. Okay, so enough of that. Let's get into that. So there is the answer for it. Now let me flip over and show you how I broke it down. So when I approach these, I write the accounting equation right on the top. It just helps me remember what I'm doing. It also guides me, and you'll see in a moment, on how to even find the answer. So I always kind of write that in some spot for myself. I also write how those T accounts operate. So on the asset side, we have various assets. Cash is one of them. Let's see. Office equipment, supplies, those would be others. The T account that's just a fancy name because it looks like a T. I can also use the word account. The account operates in a certain way depending on what it is and where it's located in the accounting equation. And is there any magic trick on remembering this? There probably is somewhere out on the internet, some sort of mnemonic. I just brute force memorization on what does what and where. That's the only thing I can offer you. So with assets, all of your accounts on the asset side, the T accounts, again, debit and credit, increases will go on the debit side and decreases will go on the credit side. Let me say that again. On the asset side of the equation, on your T accounts, debits will increase and credits will decrease the account. Totally counterintuitive, isn't it? Because you think that credits would actually increase. No, it just throw logic out the window. That's not the way it works. So just brute force memorization on this side of the equation. When you get to this side of the equation, things kind of operate more normally. Again, this is what works for me. You do whatever works for you. They tend to operate more normally. So, or I guess intuitively, again, assets equals liabilities plus shareholder equity. You're going to have liability accounts, such as accounts payable, that kind of thing. So, or notes payable, things that you owe. A liability makes sense. A note payable is basically a loan. Your loans, your liabilities are going to go there. A debit will decrease that particular T account or ledger account or account, and a credit will increase it. Makes sense. Equity, you're going to have equity transactions will be the same way. So the biggest one for equity, let's say revenue. Credits are going to increase your revenue. Debits will decrease your revenue. The one exception is, again, I always kind of make a little note to myself, the exception on this side is, I'm sorry, let me get my pen, is when you get to, and for this class, it's basically going to be expenses. Expenses operate the opposite. So I always make a note to myself, okay, the expense, also something called dividends, but we're not getting much into that at all, will operate that way as well. But expenses, you've seen quite a bit throughout projects 1 and 2. So with an expense, a debit is going to increase that account and a credit is going to decrease that account. I guess, one way to think about it is that an expense, let's say office supply expense, it's going to take away from the owners the value of the company. It's making it something shrink with an expense, so maybe that helps as far as the debits increasing on that side. I just remember, again, there's kind of 2 things that sort of are unusual patterns, and those are the ones, again, the asset side and the weird expense side. So there you go. Best I can help you with that. Brute force memorization, I always write this little piece down for myself. All right, so let's go back. That's kind of my explanation that I'll use throughout, basically through projects 1 and 2 with my little cheat up here that I use. All right, so the first, let's go back. Go back to the question again. All right, so Stockholders invest $50,000 into the business. Well, cash. Stockholders, they gave me some money. I got some cash. All right, where am I going to put it? I'm going to put it in cash. And I know cash needs to increase. So again, a debit right there is going to increase. It's almost, you can't even like think, you just like, okay, debit, increase, put the cash there. I know that the accounting equation, I put a little equal sign there. I know that the accounting equation has to balance. So that almost forces my hand in knowing where I'm going to stick the other item. In this case, it's pretty easy. We have a capital. I think, again, let me go back. We have a certain name for it, which was given, and I forgot what it was. But we have contributed capital. A contributed capital account. And I know that that contributed capital account needs to increase, right? So I just go to my cheat sheet. Oh, well, it's going to increase, so it has to be on the credit side. Boom, so I write it there. And then I make sure, does my accounting equation balance? And it does. I've got a debit of $50,000 here for cash and a credit for $50,000 cash in the contributed capital account. So that's how I got the solution for number A, going back to that. All right. Hopefully these next ones will go a little quicker after I've explained my little kind of the way I approach these problems. This next one, problem B, is a little interesting. So B is, we have on November 1st, the company prepaid 6 months of malpractice insurance for $5,100. Well, I have debited prepaid. Remember, always debits, credits. I actually got to say it to myself. Debits, credits. Prepaid has debited $5,100, and cash has credited $5,100. Let's take a look what that transaction would look like. So with my T accounts, I know I've got, let me go back here again. Okay, so the company prepaid, so the malpractice insurance. I physically took money out of my pocket, $5,100. So I know that that's cash, and I know cash in this case has to decrease because I took the money out to buy some malpractice insurance. Well, sure enough, if I go up to my assets, and cash is an asset, if a credit is to decrease it, so I'm just going to put my $5,100 there. Okay, so I got that taken care of. Now I've got to figure out, well, how do I get this thing to balance? There's other, there's other ways to do that. And what this one is interested is that the balancing happens on just this side of the accounting equation. We're just going to balance it within the asset side. I've got nothing over here on the liability and equity side. So what I want to do with prepaids, and there it's prepaid insurance in this case, the malpractice insurance, I want to increase that. Now that's an asset. I have prepaid, I've bought something. It's like going to Kroger and buying an Amazon gift card, right? You've got this Amazon gift card. It's worth something, right? You're going to turn around eventually and buy stuff at Amazon with it. But in the meantime, it's worth $50, $100, whatever. So it is an asset. And so are the prepaids. They're assets. Now, as they get used up, that triggers other accounting events. But so that is an asset, and it's going to happen staying on the same side. And I'm going to increase that asset, going back to my little cheat sheet up here. I'm going to increase that asset, and I'm going to put a debit in there. So cash will be credited $5,100, and my prepaid, again, prepaid insurance, will be debited $5,100. So that's how I get the answer for that one. I think everybody did really good with most of these, almost all of these. All right, so let's take a look at C. Okay, a company's borrowing $15,000, and with principal and interest due in 3 months. That doesn't mean anything. Basically, what's happening right now? I borrowed $15,000. what's the accounting, the accounting effect? Well, cash is going to increase. I'll go back to my little cheat sheet. Cash is going to increase. Again, debits, credits to increase cash as a debit transaction. I know I got to have a balanced transaction. I know I have an obligation, a notes payable. Debits, credits. I'm going to credit that note payable, $15,000. Let's just make sure I'm doing it right. Yep, that's definitely with a liability, which a note payable is, fancy word for a loan. That note payable is going to have a credit entry and work. It works. So that's I guess one of the somewhat satisfying things about accounting is it sort of, because of the double entry setup, it kind of solves itself and helps you make sure you're okay when they balance. It's always very satisfying when it all balances out. All right, so let's take a look at D. With D, okay, if we're buying some stuff now, we're getting an exam table and we're getting the office equipment. So that can be all lumped into equipment. Equipment is an asset, and we had to get that equipment because we bought it, right? And there's nothing here about we bought it on loan or leased it or anything like that. So the assumption is that it was purchased with cash. So in this case, you have your equipment totaling the two items together. I just kind of quickly cheated and just added them together, $20,000. So you know that equipment is an asset. Remember, debits, credits, to increase and add it, an asset, it is going to be a entry to the debit side. So I just put that in there. Equipment's going up by 20. And cash, well, I've just taken money out of my account. And I know that even if I didn't know what to do, I knew it would be cash, and I knew it would have to balance. So I could almost not even know and just put in cash and just write the offset, the balancing part of it. But let me just check myself. So I'm decreasing my cash, and cash is an asset. So a decrease to an asset is on the credit side. So yes, yay, it worked. Again, no impact to this side of the accounting equation. It's not always on, each side of the equation. It can be relegated to one side or the other as long as the net effect is balance, is equal. All right. So let's move on to E and F here. I'll kind of scooch these up a little bit. You can see I have my little cheat sheet, again, written up here for myself. So with E, we are now, we have purchased $300 worth of supplies on credit. You can see the answer here. Supplies has to go up. I've got stuff. I bought some. I went to Office Max and bought some stuff, right? And I used their buy now, pay later option, and that's accounts payable. So they so I have supplies. It's an asset. You know that, again, going back to the cheat sheet on here, that to increase an asset is a debit entry, so that's checked. And accounts payable, which is a liability. Again, I owe something. It's like a layaway or whatever. You got to pay something eventually. Credit card, if you will. And I'm going to owe money. So in order for a liability to increase, it's a credit entry. Okay, I write that down. And does it balance? I got a debit, I got a credit, it balances. Yay. So that's good. All right, let's take a look at the next one. The next one, a 3 entry in here, not to make you, it should, again, wasn't trying to confuse anybody, but just throw an extra transaction, piece of the transaction in there. So you start seeing patients. You've received $8,000 in services, or you've given $8,000 in services to patients for your practice. Your records show that you've received $3,000 in copay, and you've billed insurance out for $5,000. Okay, so you got the copay, right? We've all paid a copay, and sometimes we just pay in cash or we pay in credit card. that's irrelevant for the entity. The entity is receiving the money. So whether you paid a credit card or a check or whatever, it doesn't make a difference. They got cash. Might take them a day or two, but they're going to get the cash. If you wrote a credit card, they have to batch that out at the end of the night, and then they eventually get paid on their money. But still, they get paid. So just think of it like cash. All right, so they got $3,000 in cash from all those copays. I won't go back and flip back and forth now because I think you got the pattern. With the asset, cash, debit, credit, to increase on the left side, right side, to increase that cash asset, because we got money in our hands from those patients, it will be a debit entry. So we got that. Accounts receivable. That is an asset. People, somebody, something owes us money. And we're going to get that money eventually, but right now it's an asset for us. And we want to record that as such. So we've got accounts that are going to be receivable to us. Okay, you got accounts payable, one thing, what I owe to others. Accounts receivable, what others owe me. But even though they haven't paid me yet, I still count that as an asset. You're probably saying, well, Chris, maybe they don't pay you. Well, that happens, and there's loss provisions and all that stuff, but let's not worry about that. Let's assume everybody's really good and pays, okay? So accounts receivable. All right, so on this, we've got the $5,000 that we've billed to insurance. I'm sure the insurance people will pay us eventually. And then the revenue, now remember, I will go back. I lied. I'll go back one more time. Remember that revenue is on that equity side over here. And to increase revenue is going to be a credit transaction. So let's see. Yep, there we go. So I've covered that in the credit side. So the $8,000 in patient revenue. Again, check myself. 3,000, 5,000 equals 8,000. Again, debits, credits equal, check. Done. So that one looks good. All right, let's look on to this one. Okay, on November 30th, the company pays employees $8,200. Okay, so you've paid some folks cash. Okay, think of it that way. Obviously, you had to come up with the money to pay your folks. I'll just talk about the cash one real quickly. Okay, so now, again, cash is our buddy. Cash is our friend. We're using cash a lot of times in these transactions. So now we're decreasing cash, which is going to be a credit entry to cash, which again is on the asset side. It's counterintuitive. You're crediting cash. You're putting a credit entry in cash to actually take it down. I know it doesn't make sense, but you just got to think of it backwards. And then with wage expense, okay, so wage expense has been incurred. So, oops, sorry about this, guys. Wage expense, where am I? There we go, wage expense. All right, so let's flip back to my T accounts. And we have the wage expense here. I've made my T accounts. I've put my debit, my credit to cash, $8,200. My wage expense, I know I could almost, again, not even think. I could just say wage expense, it's got to offset, it's got to be a debit. But let me just check myself to be sure. I go up to my little cheat sheet. Remember I said expenses are kind of weird. They are the counterintuitive one. That's why I put this little goofy little circle around there. So expenses, if I want expenses to increase, it's going to be on the debit side. Did I do that? Yes, I did. And does it make sense? Yep, it does. It balances. So I've got my my credit to cash and my debit to wage expense. I've got a balancing transaction. So good. All right, let's take a look at these final few here. All right, so we've done our payroll. Let's talk about this one. All right, so on November 5th, you received a bill for $2,500 for rent and utilities for the office space. Okay, this is also an event. Okay, so you've received a bill. You have in the mind, I guess it's a very logical system. You've incurred an expense, but Chris, I haven't paid the bill yet. in the mind of accounting, you've already incurred the expense. Whether you pay the bill or not, that's a whole other problem. But you've used up the rent. You've been living there, where you've had your office there, right? So that's not going away, and they're going to sue you if you don't pay anyway. So the expense has been incurred, even though you haven't paid it yet. But that's where the beauty of accounts payable comes in. Just like us, when I go and buy something at Costco and I put it on credit, I've incurred the expense for my family, but it's not payable yet. So until I get the bill. But the expense is there. All right, so in this case, rent and utility expense has been a, again, debit of $2,500, and I have credited accounts payable for $2,500. Let's go back up to, let's go to my cheat sheet here. So if we go back to the cheat sheet, we have an accounts payable. That is a liability, so I should have a credit entry on there, which I do. And I've incurred an expense because it's already happened, whether I paid it or not, and that is the I think we call it rent expense, but we've incurred an expense, and that would be a debit entry. So yeah, our your rent and utilities expenses is what the name for it. So so then the accounting the accounting equation works. In this case, we are sticking, let me go back to my little piece of paper here. This is one of those ones where the balancing all happens on just this side of the equation. We're not balancing here. Again, the net effect is a balance. So good. So I always check myself. All right, so we've done that. All right, now let's go on to our next one. On November 15th, you have received insurance checks. Hey, they're starting to roll in. The insurance checks. Remember those insurance checks that you had before where they were owing you money? Okay, so you've received insurance checks in the amount of $3,500 for services provided in November. Again, with the journal entries, this is just for the date, so trying to get you guys used to putting in a date in there. Okay, so I got some money. I got $3,500. Again, cash is our buddy. Cash is our friend. To increase cash is a debit entry of $3,500. I think we're getting used to how weird that is. And accounts receivable. Okay, so my accounts receivable, which is an asset. People owe me money, but they've made good on that promise to pay, I guess, that accounts receivable. And I've made a credit entry for $3,500. So this is one of those transactions that, let's go to my little T accounts here. That's happening all on the same side. So I have a debit to cash and a credit to accounts receivable. I'm bringing that account receivable total down. They're no longer outstanding anymore. Okay, so that one looks like a balancing transaction. Let's go to J. Some of you did have problems with the final few of these. On December 16th, you send a check to pay in full the November rent and utilities. Okay, so you finally decide to pay your rent. And so you have to, almost intuitively, you know that you put something in accounts payable, you got to do something to that, and you know you got to do something to cash. Well, if we take it, let's just take it from the cash approach. Remember your old buddy cash, right? So a decrease to cash is a credit entry. You could enter that one without even thinking. Accounts payable, well, that's a liability, and if you remember, those liabilities are more normal, where you have a debit on one side and a credit on the other. So on the accounts payable, you are now going to put a debit in there for $2,500. So you have now reduced, again, we can actually see it right up there is where it was. It's still on the same page. I didn't plan that. So here was the where you owed the money, right? You had the accounts payable back a couple of transactions ago, and here's where you paid it. Now the net effect is I don't have any more accounts payable. I've cleaned that out. I've paid that. So that kind of works there too. So again, almost a double check with that. And now we got a balancing transaction for J as well. Okay, let's move on to K. And K, you've provided $23,000 of service to patients. You've received the copays. Remember, that's cash. You got the copay money, $2,500, and you've been billing insurance for the rest. A little math there. You got to figure out what the rest is. So with this one, again, our buddy cash is going to increase. That's a debit entry for $2,500. Accounts receivable, remember that's an asset. That's also a debit, one of those debit counterintuitive asset accounts where to increase it, you're going to put a debit entry. So for the remainder, for the $2,500, we're going to put that in accounts receivable. And you've had the revenue. The revenue, the thing has happened. That you've provided the service, and the revenue has been, I guess, received, or has been realized, I should say, but not necessarily received. So the event has already happened. You provided the service to the patients, and that is where you would have to put a credit entry on there. That's on the other side of the accounting equation. Remember, it's assets equals liabilities plus equity, and that revenue is one of those kind of equity accounts, and acts, I guess, more normally because an increase is a credit entry. And you double check, add those all up, and it does balance. Okay, so that's how you do the journal entries, at least the way I approached them. Now, and this again, I thought the book might have been clear enough, but for some folks it really wasn't, and I could see where you kind of got awry on this. So no fault to you. I would accept all fault on myself on this, on how to do these posting transactions. So here, what the intent is, you basically take all that stuff that you did in these transactions here, and you don't think. You just record them, and you record on the debit or the credit side, and then you'll net them out in the end. But that's all I did. So that's what really the intent was here. So all the transactions that we just went through, the $50,000. Remember the $50,000 we received from the owners in the very beginning, and oh, there's the payment. Remember the $8,200 we paid for those employees who want their salaries? Gosh darn it! The credit entry to reduce that cash amount. So basically, just your debits minus your credits, whichever side, you subtract one from the other, whichever side is the bigger side. And in this case, you have a debit balance in cash, which means we have some cash, and think about cash in the bank of $38,200. And you would do that for each one of these T accounts. And you can also see how they're kind of laid out as far as the accounting equation here too. So some of you probably used this as you were working through the problem, kind of skipping forward and looking at this part of it too, because it does help, again, with the T accounts listed here and the categories in which they are listed. So that's how you were supposed to do that. Again, just netting those out. In some cases, you only had, many of them, just single entries. So you just, supplies. Remember how we bought some supplies? We have $300 in supplies. We just put the $300 in there, right? Nothing else happened. We didn't do any adjusting entries, which is project 2. So we had $3,000. We're assuming a $3,000 balance there. And the equipment we bought, it's still there. So, and then the trial balance is simply taking all of these summations of these T accounts and plugging them in wherever they dictate. I mean, if it's a credit or a debit, it is what it is. Again, almost kind of non-thinking. And that's what I did when I did this. I really just did, okay, so I didn't think about anything other than what was the result. When I did the cash, added it up, The cash was ultimately a debit of $38,200. Again, I repeated that all the way through here for each one of these. Now the gut check at the end, and I did this a couple times, so hopefully I got it right. But the gut check at the end is right here, is when you add them up together. Remember, whatever you're doing throughout this entire thing, things should always be in equilibrium. You should always have balance. So you add them all up together, one column and the other column, and they should equal. Again, that's one of those little satisfying moments like, oh yeah, it does add up. Unless I did an error on both sides equally, which I have done. But in this case, your total should be $96,300. Now, a couple of you did get the exact answer on the trial balance. So again, congratulations to you on that. I know it's just one little error can throw you off throughout the entire process. Now, when you get an error, what I do is I look at the amount of the error. So if I go, why aren't they balancing? They're off by $500 or whatever. Sometimes that difference can help me focus in on the transaction that caused it. So I don't have to look at every transaction. Okay, so what transaction was for $500? What transaction was for $3,200? I go back and look at it. Did I post it correctly? Did I mess up on my debits and credit side? So sometimes that can help if you do have a difference in those columns. Okay, so that's a walkthrough on Project 1. Now, I'll pause here for a moment and then we'll take a look at Project 2. All right, let's step in here and look at Project 2, my solution. Project 2, hopefully a little simpler. Project 2 is about these adjusting entries. So think of it this way, an adjusting entry, right? Let's go back. I like supplies. That's kind of why it started off with supplies. So let's say you buy a bunch of supplies. You remember you bought those $300 in supplies. People are taking pencils, pens, whatever, throughout the time period. You're not going to go over to Dr. So-and-so and say, how many pieces of paper did you take today? No, you're not. So you'll do an inventory and you'll see how many supplies are left. And then it's just more economical to do it that way. You just no way you could micromanage it to that detail. Now, I will say, as technology gets much more sophisticated with inventory management and things, a lot of these are becoming very, very dynamic, happening, instantaneously. But, right now we're not quite to the future. So this is the most economical way to do a lot of these things, is through these adjusting entries. Okay, so with you've done you've sent little Joey back to the supply cabinet, and he's come back and he says, okay, there is $175 worth of supplies on hand. Well, you know that you started off with 300. Let me go flip over to my little solution here. Oh, so Project 2, here we go. So my little cheat sheet that I made for myself. Again, I always write my little accounting equation on there. It helps me not get lost, because it is so easy to get lost with this. And I try to think very linearly, if I can say that, in each one of these. Kind of break it down to each single component. All right, so in this case, I knew we had 300 in supplies. I used the inventory showed that we had 120 or 175. I knew I'd used 125, so I've got to make an entry for that. I got to make an entry for that use. Okay, so supplies is an asset. We're going to decrease that asset by 125. So I know I'm going to have an entry, a credit entry to supplies of 125, and now an expense has incurred. I've used something. That's what an expense is, when you kind of use something up. And I've used up supplies, so an expense has incurred. Remember, expenses are one of those weird transactions or weird accounts on the other side of the accounting equation, where it operates where debits increase expenses and credits decrease expenses. I want to increase my expenses. I've had an expense, so I'm going to put a debit entry. So sure enough, I've got a credit on supplies and a debit on supply expenses, and that yields me a nice balancing transaction there. So this is the entry that I would make, my adjusting entry. All right, let's take a look at this one. Some of these are a little bit more critical thinking, in some of these. So I hope I didn't throw you too much by this. So like this one, so by December 31st, again, I put the date in there, you determine that you have used 2 full months of malpractice insurance. Oh, Chris, where's the other information? Okay, so if you remember our malpractice insurance, originally on Project 1 was $5,100. Now that, and you remember, if you go back and read it, it was for 6 months of insurance. So right there, $5,100 for 6 months of insurance. Again, just divide by 6. I know I've got $850 per month. Now, again, computers and software can help you calculate all this stuff, but we're going old school here. So, and the problem said we had 2 months of insurance that has happened. If you remember, we prepaid all that stuff up front, right? So, and a prepaid is an asset. So now I need to decrease my asset. Okay, so I know it's going to be a credit entry. So prepaids will have a credit entry of $1,700. And now I've incurred an expense. I've needed insurance for 2 months. Even though I've prepaid 6, I haven't used up the entire 6 yet. It's only when I use it then I incur the expense. So I'm going to have an expense of $1,700. Now, I could just blindly put it on the debit side, but let me make sure and check myself. Expenses, yep, to decrease an expense, I do have to put it on the debit side. So it wonderfully, thankfully works that I have that, the entry here for $1,700 on the credit side for prepaids and a debit entry for insurance expense. Yep, again, debit, credit for $1,700. Again, debits here, credits here. I'm not saying that to be sarcastic. I'm saying that as a memory aid to myself. All right, so here we go. All right, and a couple more real quick. Okay, so you've calculated the depreciation of the office equipment to be $1,800 for the full year, and you need to make an adjusting entry for 2 months of depreciation. Okay, so you buy things. You buy equipment in a business. Okay, a building, a CT machine, office equipment, whatever it is. You buy this equipment, things that have these long life to it, right? So you have a piece of equipment that's going to live for, let's say, I don't know, 10 years, right? You're going to use this thing for 10 years. Well, the way like the IRS works and for accounting is that you're allowed to incur an expense for that transaction. So you over a period of time. So let's again, you buy this office equipment. I forget what the original price was of the office equipment. I'll just say $10,000, right? So $10,000 for office equipment. You're going to be using it over 10 years. At the end of 10 years, it's going to be junk. It's going to be worthless. Okay. Rather than taking an expense in 1 year for $10,000 for the equipment, wouldn't it make more sense that as you're using it up, remember that's kind of the trigger too, that you're using something that's where the trigger, the event happens, that's going to incur the trigger of an expense. As you kind of use up that equipment over the 10 years, that's when you want to realize that expense for the equipment. And for tax purposes, it helps out too, right? So you want to kind of get that tax benefit of expenses. And it's not cheating. It's legitimate. I mean, it's the way it works. It helps really allocate how that expense was incurred over a piece of time. All right, so this is how we. So that's my little thing on, I guess, on depreciation as we're getting into this. So you've got this equipment. You've determined there's all kinds of ways to do depreciation, straight line and double declining, or whatever to figure out how much something decreases in value before it's worthless. But in this case, I give it to you. So $1,800 for a full year. you need to make an adjusting entry for 2 months. So you can do the calculation. You've got years of depreciation is that 2 months is going to be ending up being $300. So actually, let me just double check my math on that real quick. I'm actually hesitating here for a second. So we've got 1,800 divided by 12. Okay, yeah, cool. Okay, so each month is $1,500 or $150. 2 months, $300. So what we're going to do is we're going to have an entry to accumulated depreciation, and in the book it does talk about depreciation. There's actually a lot of these are actually, if you see copies of this in the book, things are changed, scenarios are changed, dollar amounts are changed, but you can actually see how they've entered these, and depreciation is one of them. So you have something called accumulated depreciation. That's where we're going to stick it, the $300 for depreciation in there. And that is going to be used to decrease the value of your asset. It's something called a contra account. It will be used to offset that asset. You don't need to know all that part. I guess just know that accumulated depreciation it lives on the asset side of the equation, right next to its buddy, and its buddy is the thing that you're depreciating. So in this case, it's the office equipment. So it lives with the office equipment. And you are going to decrease the accumulated depreciation. So, or I'm sorry, you're going to increase accumulated depreciation. It's going up, and every year it's going to go up. Every year this thing is going to start getting larger and larger and accumulating. So to decrease that on the asset side will have to be a debit entry. Hold on one second here. Maybe I did make a mistake here. So accumulated depreciation is on the asset side. We are going to we want to show an increase on accumulated. Yes, so we're going to have a depreciation expense for sure on this side. So depreciation expense will be realized. Just check out, I'm balancing my equation here. I know that has to exist. All right, so so what we're going to have to do. Okay, what we're going to have to do here. Okay, actually, I answered my own question now that I'm thinking about it. All right, so what? Because it's a contra account, and it's like, I know there's all these little rules in here, but it's a contra account. Contras are credit-based accounts on the asset side. So I guess brute force memorization. I was like, why did I put that on there? Oh, it's a contra account. That's right. Contras are always assets on the asset side, and it's always a credit account. So again, I guess sort of brute force memorization might help there. The other, and I'm trying to think of this intuitively, how could you, without knowing that, you'd also know that it's got to be used as a contra account that's linked to an asset that's being depreciated. You know it has to impact that asset. Now, an asset's going to carry an entry on the debit side. So that $20,000 of equipment is going to be listed on that debit side. And in order for it to kind of dwindle down, I know it has to be a credit entry, and will always be that contra account credit entry on the asset side. Whew. Okay, so that's why that's there. I was like wondering, wait a minute, why did I put it on the other side of the equation? Oh no, it's asset. It is a contra, and the key is a contra account. Again, the book does talk about contra accounts, and that is in there. So now I do the final check. Do I have a balancing transaction? Yes, I got my expense. I know is, that's great. You got that on there. That's not a question. And even if you didn't know where accumulated depreciation was, asset, liability, whatever, you would know that you would have to have a credit entry in that accumulated depreciation. So, so there's that. All right, and let's go to the I think the final one here on D. Okay, is determined that the income taxes before taxes is $20,000. Given a 35% tax bracket, make the record for the income tax provision. So with this one, again, there is an illustration that talks about taxes in the book, but you can almost kind of copy that. But let's just think of it intuitively. So we have an expense, income tax expense. How did I come up with $7,000? Well, again, a little bit of, let me just shrink this down a little bit. Sorry, guys. So you can see that final bottom of the page here. And we'll go down here. Okay, so here we go. All right. So income tax is 20, tax rate is 35%. Just simply multiply, you get your $7,000 right there. You know that you're going to have an income tax expense whether you've paid it or not. Remember, the thing has already happened, so you have to record it. So you know that, going back to the little cheat sheet up here, is that it's going to be an expense, and to increase an expense, it has to be on the debit side. Did I do that? Yes, I did. Okay, good. So I got $7,000 in income tax expense and income tax payable. So I have a liability. I got to pay this eventually. And again, to increase a liability, it's going to go onto the, remember, debit, credit. It's going to go on the credit side. Let me go back to my better cheat sheet right here. So to increase that liability, debit, credit, it's going to go on the credit side. And yes, I did that. So, and the two balance. So there you go. You know that you've got that part done. Or at least it balances out. All right, so let's go back to, let's see here. In all of this, I think I have moved. All right, so that's, sorry about the scrolling there. I know that makes you crazy. So let me go back and pull up. I've lost the other one as I was moving my stuff around. Let's go back to finish this out here. There we go. All right, so project 1, let's move on. Let me just resize this so we can fit into our window. And I'm going to scroll all the way forward here. We've been moving through project 2. We've got all of our entries in here. And then the posting the transactions, same process as before. Now with this, again, the fault here is that some of the starting unadjusted balance numbers were not exact and carried over from project 1. But I guess you don't really need to use those. You can look at each of the projects somewhat independently. And again, I'm not taking points off if you went back and used the original ones. That's my fault. Like there was one of them, a couple counts in here that with this example were, these numbers in here were incorrect, and I forget which one it was. But some of these numbers in here, I don't know if it was notes payable or whatever. One of these in here was incorrect. But again, it won't affect the process of what you're doing. So you're just basically taking the numbers that are given and you're recording these 5 transactions in that area. And you can see where I kind of scribbled down my, and again, I'm not thinking, I'm just going as a debit, credit, I'm sticking it on that side, and I'm just leaving it like that. So in this case, I had for prepaids, we had the 5,100. We used up some of the prepaids, so that's the adjusting entry on the debit credit, on the credit side of 1,700. That left me with the ending balance of 3,400 on the debit side. So that's all I'm doing there. Again, very similar to what was done before. Again, on this one, I do apologize. I didn't have one on here for income tax expense. So I just wrote a little one down there on when we did the income tax expense transaction, a little T account there, which should be, whoops, let me turn my pen off here, which should be under the equity side. Remember, expense is one of those weird accounts that an increase is a debit. All right, and then I net those out just like I did before, coming up with whatever it is, the number, again, whatever the number is on each side, whether it's a debit or a credit, whatever is the larger of the two sides, subtract the one, you're going to get a single figure at the end. And whatever that figure is and whatever side that it's left on, I think you guys get that part, because you're obviously going to have one side that'll be, in this case, it would be, 5,100 minus 17, adjusting entry, there. If this for some reason was 10,000 on this side right here, whoops, 10,000. If it was, I'm talking about prepaids here, guys. So if I had 10,000 listed here for some reason, whatever, then it is what it is. My balance would be, 4,900. Remember, debits, credits on the credit side. Again, I'm not thinking. I'm just simply adding and finding up what side that's going to be on, adding and subtracting. Then I take those totals, those netted totals, and I put them in the adjusted trial balance, which you'll see listed here, cross my fingers and add them up. So in this case, again, I did it a couple times. Again, if you see anything that you question, let me know about these transactions. But you can see here that we've got the two sides equaling. It's 103,600. Again, it's always very satisfying to see when those two sides, let me go back again, when those two sides add up together. You feel pretty confident, at least you try to feel pretty confident, that you've done it correctly. All right, so there are the solutions for projects 1 and 2. Again, my objective was not to make you accountants. I know there's a lot of number phobia out there, and that's perfectly understandable. Some of us love them, some of us don't like them. Try to be light on the math. Really more, this is project 1 and 2 is to introduce you to a process. And I think we accomplished that, where you got the feel of kind of what's going on. In real life, you guys will not be dealing with these kind of minutia in the ledger accounts. You're going to see the product of those ledger accounts. And as a manager, trust me, as a manager, it is super important that you do watch your ledger accounts. Many times, and I work for Mercy Health, and a transaction might be not posted to the correct ledger account. So I'll call our director of finance and I'll say, hey, why is this here? Oh, okay, I'll move it over here. And it can make a big difference. So and having an awareness of kind of the back end of how these things work is what's important. Remember, the goal of the class is really to give you an idea of the underpinnings of accounting and how to use that as a tool for decision making. That's kind of the ultimate goal here. And we'll talk more about I think the decision making part, especially with project 3, where you're going to be, I'll call it project 3,4, where you're going to be looking at ratio analysis. That's the part that I really get excited with, is that because that's kind of tells you what's going on with the company and the health based on the numbers that you've produced by doing all this kind of minutia, this kind of stuff. So hopefully this helps. I wasn't trying to make projects 1 and 2 frustrating, but I know many of you were frustrated with that, so I apologize. If you have any questions in seeing this again, please let me know, or if you think I've made an entry incorrect, let me know as well. I'm always happy to kind of look at that. That's kind of the fun, I guess, with accounting. It's sort of a little puzzle, and each transaction is kind of its own little puzzle. So it's kind of I don't know if you like those kind of things. So, all right, that concludes that. Stay tuned for a normal week in review video that will be happening as well, but I wanted to isolate that away from projects 1 and 2. Thanks, guys.